Welcome back. I'm here today with Joe McKissick. He's a financial consultant here in the Bay Area. Joe, welcome to today's show.
Thank you. Nice to see you, Alan.
So, Joe, give me your background, your journey through life. What brought you up to this point today?
In junior high or high school, we had a project where we had to, select a stock, and so we did that, and that kind of got me interested in the stock market and investing. And ever since then, I had a passion or a desire to learn more about the market.
I always admire people that can be financial consultants. I'm a CPA, and so people will come to me and they'll have tax issues and things like that. But people coming to the financial consultant, they're saying, Joe, solve my life's problem of giving me a good rate of return.
Yeah.
And make sure whatever I give you to manage doesn't go down.
Right.
And so how do you approach a person who is extremely conservative when markets are so volatile?
It's important to kind of take a step back with that client. And first and foremost, talk about financial planning, retirement planning. I think every investor should create a financial plan. It's your roadmap to financial success. And then you can figure out within the context of that financial plan, what should my investment strategy look like? What type of rate of return do I really need to meet my long-term retirement goals? So it really all comes back to planning and having that roadmap in place.
Now, is there a certain benchmark of net worth you like to deal with? In other words, do they have to have at least some liquid assets before they can really be involved in a financial plan?
I work with individuals who have a minimum of $250,000 of investable assets and up. And I work with a lot higher net worth clients as well.
And so when you're walking through this, what are some of the greatest concerns that when clients come to you that they express? What are they feeling out there right now?
They want to be financially independent, and not everyone has that ability to do that where you have true financial independence. A lot of people, they rely on their investments to help them maintain the lifestyle that they want to maintain throughout their lifetime. People's concerns are not living a comfortable retirement, not living by the means that they're used to living today. So I'd say that's probably one of the greater concerns, and then obviously the volatility in the market is a concern. Markets are up and down. People sometimes ask the question, is now a good time to get into the market? Should I be getting into the market? The market's all over the place. And then it comes back to planning. It's like, okay, what is your financial plan? What type of rate of return do we need to accomplish to maintain your goals? And then within the context of that plan, make your investment decisions.
Now, if the market is falling,
yes,
it's falling hard and fast,
yeah,
and you get a client calling in a panic, Joe,
yeah,
help me,
right,
help me. Yeah, what's
right,
your typical approach to,
right,
how you should react to that?
Right. Yeah, no, that's a good question. It's a long-term investing. We're investing for the long term. Okay, the markets are going to go up and they're going to go down. They've always done that, and they will continue to do that. I had a client that had that type of reaction, and we were systematically, automatically investing into an index fund. Just, he was putting money in his 401k. He was putting money into just he had additional savings, and so we were dollar cost averaging into an index fund. He didn't need that for a long time. He had plenty of liquid assets to cover any needs that come up. He had an emergency fund. So everything was in place. This was just a long-term investment. He says, I want to stop. I don't want to put into the market right now. And it was really bringing him back to, this is a long-term investment, and with this particular money, the market's going down, but now you're accumulating shares at a lower price, and you're accumulating more shares at a lower price over time, 10, 20 years from now, when you actually, maybe need this money, you'll have accumulated a lot more shares at a lower price. So don't stop investing, when the market's necessarily down. In volatile markets, people should make sure that you have your portfolio, your target allocation should fit within your risk tolerance.
Joe, I need to take a quick break, and when we get back, I want to talk about allocating portfolios and risk tolerance.
Okay, sounds good.
Visiting me here today with Joe McKissick, a financial consultant here in the Bay Area. We'll be right back after these messages.
I love fishing, with my family.
I think it would be easier to use a net.
It was so much fun.
The times when we are together, it makes it all the more worth it.
Having Dad teach them how to cast a fly rod, and
as long as we're doing stuff together, we're having fun.
Some people see a father and a son fishing together, while others see a succession plan.
Welcome back. I'm here today with Joe McKissick. He's a financial consultant here in the Bay Area. And Joe, in the first segment that we were talking, we got into this allocation and risk management. And what exactly is that?
There's a few different philosophies, investment philosophies. There's your stock pickers or security selectors, there's market timers, and then there's asset allocation. And I believe in asset allocation for long-term investment. And basically what that is just having the right mix of asset classes that fit your tolerance for risk. So a more conservative portfolio might have an asset allocation that has more exposure to fixed income as opposed to equities. A more aggressive investor or a more aggressive asset allocation model would have a portfolio that has more exposure to equities. So essentially asset allocation is just how your assets are allocated amongst different asset classes. And so it's important to get that right for long-term investors, because as the market goes up and goes down, when the market's going down, you want to make sure that you're comfortable. No one's happy when the market's really going down, but you want to make sure that you're comfortable with how, can you stomach or tolerate the decline that you've seen in your portfolio. And that's really a function of how your assets are allocated or diversified.
Now, when we're looking at retirement today, I hear all sorts of things out there, everything from don't plan on having Social Security to plan on working much longer. And I realize for every financial consultant, it becomes more of a personal opinion or issue.
Right.
And but as you approach a philosophy today, when we're moving out and looking into the future, volatility of markets, there's a lot of paradigm shifts out there with all the baby boomers exiting. How do you help someone to navigate all these rocky waters? Or
yeah, well, I really try to listen to my clients' needs and what's important to them. Every person, every client is different. People have different goals, they have different objectives. So I really try to understand, what are you trying to achieve? What's important to you? And I think that's the first thing, is partnering with my clients so that we're in this together to try to achieve their short-term, mid-term, long-term goals.
And so when we're looking at long-term, are we looking at 2 years, 5 years, 15 years? What?
Yeah, I mean, I'd say long-term would probably more 10 years or greater. Yeah, I'd say 10 years or greater.
Okay.
Short-term, I don't know, there's probably 2 years or less would be short-term. Kind of intermediate term would be 2 to 5 years, and then longer term, gets into the 5 to 10 plus range. People are living longer though, so it's important to invest for the possibility of having a longer lifetime. I don't know if Social Security is going to go away or not. That's not my job to make those predictions or really have an opinion on that. But if my client feels that I don't think Social Security is going to be there, well, then let's plan for it not being there and save more money.
That's a good way to look at it. It's,
Right.
No one really knows where the markets are going, and I think everyone has a inner feeling inside themselves.
Right.
Would you agree that if a person was having to watch the stock market every day, they probably have too much money in it? Or they're investing money that they can't afford to lose?
If they were watching the market every day?
Constantly watching the market?
Yeah, I mean, that's, some people just love watching the stock market. That's,
Okay.
that's what they do, and they enjoy it. For people who are doing long-term investments, in my opinion, you don't need to watch the market every day.
Call Joe.
Yeah, call Joe. If you have a concern, let's talk
Yeah,
about it.
Yeah,
you know?
yeah. Okay. Joe, I need to take a quick break. I'm visiting here today with Joe McKissick. He's a financial consultant here in the Bay Area. Stay tuned. We'll be right back after these messages.
When I grow up, I want to work with very successful people.
I want to advise people so that they can pay less tax.
Hang out with my clients on the golf course.
Fishing.
And on their private yachts.
They will all be my friends too.
I want to work with the VCs who will fund the next Fortune 500 company.
When I grow up, I want to be just like my dad.
Money won't buy you happiness in life, but we can help take care of your financial affairs so you can focus on what's really important. Welcome back. I'm visiting here today with Joe McKissick. He's a financial consultant here in the Bay Area. And Joe, in the past segments, we were talking about risk management and allocation of portfolio. And, you know, all this is well and good, but let's say that I've never had an experience of talking to a financial advisor before.
Mm-hmm.
When is a good time to know whether I should be working with one versus not?
That's a good question.
I mean, because you're not going to just work with anybody that comes through your door, are you?
No, there needs to be a good fit for both a person looking for a potential financial advisor, and the financial advisor has to have a good fit with that person. That's what I feel.
Yeah.
I think if you're starting to have that question, like, should I be talking with a financial advisor, then I think that's probably a good time to go talk to one, interview maybe 1, 2, or 3. Speak with your, if you don't know where to start, talk with a friend of yours. Ask, who do they work with? Some people like to mention their financial advisor to their friends. Some people don't. You could ask your CPA. They often know a lot of financial advisors, as I'm sure you do. But if you're having that question, should I be talking to one, then find out a few to go interview or talk to. Brainstorm, come up with a list of questions that...
Like what? What's a good question? Is the stock market going to fall?
Yeah, I mean, that's a good question. There's no bad question.
Yeah.
Okay,
yeah.
There really is no bad question. I think the more questions you ask, the better off you are.
So if I can say that what you're trying to do is trying to identify with somebody who can be a check and a balance to you.
Yes. Yeah.
So if I say the market's going to fall, then you'll say, well, wait a minute, maybe not. Maybe not.
Right, yeah. So
yeah.
exactly. So I can work with my clients, talk them through
Yeah.
situations or volatile times.
Mm-hmm.
Hold their hand when things get tough. Help them take the emotional part out of investing, because it can get emotional for people and their money.
Yeah.
And consultants, advisors, they have they're your soundboard.
Yeah.
Ask them questions, get their opinion. If you have a major life or financial decision, ask your financial advisor.
That's a good point there. But when should people, I mean, you can have life events such as a large inheritance.
Yeah.
But let's say it's a new kid coming out of school.
Yeah.
They finally got a job paying them a W-2. Should they think about investing early?
Yeah, I think so. I think the earlier the better. Really, time is your friend when it comes to investing. Mm-hmm. So the earlier.
And what's a good place to start? Should they, go pick up a magazine and look at the top 5 stocks for this next year, or should they do an approach of putting money into an ETF or some type of managed fund? What do you think?
Yeah, well, I think if you can start, contributing to some type of retirement account, an IRA, a Roth IRA, a company 401k, that's good. In addition to that, invest in an ETF, an index fund, something like that, where you're automatically maybe putting, say 10% of your salary. You're just automatically on a monthly basis investing that money in some type of index fund or ETF. To me, the vehicle itself, it matters. It's important. How much does it cost? Is it tax efficient? There's certain questions that become a bit more detailed. But the sooner you start, the better. And if you pick a couple similar funds, in my opinion, 10 years from now, 20 years from now, provided those funds are somewhat similar in nature, you're going to get to the same place.
Yeah.
The path might look a little different, but you're going to get to the same place. So just find the right investment that fits your preference, your time frame, your risk tolerance.
Do you have a special type of client that you or type of client that you specialize in?
I work with professionals,
okay,
approaching or in retirement, and I like to work with folks who like to make investment decisions within the context of a plan. So we're planning based. We have a retirement plan, we have a financial plan, and all investment decisions come, you hear me say this over and over again, but I think it's important. They're made within the context of that plan. So people, professionals in near or in retirement who like to invest within that type of philosophy is who I enjoy working with.
Does working with a high net worth individual differ than working with a common everyday W-2?
Yeah, well, yeah, no, that's a good question also. Yes and no. I mean, a high net worth individual has a few more zeros after their account statement, but everyone has, high net worth individuals or just your everyday average Joe. We all have financial needs. Everyone has goals.
Yeah, I love the way you put that because, so often in life, you'll have the guy or the girl or, they're looking for, I need to save for retirement, I need to save, and then they get to retirement, they got the savings, and all of a sudden their health fails.
Yeah.
And like, well, what just happened? You just went through life to get to retirement only to find out that you got other challenges of, how long you're going to be around.
Right.
So when we're looking at consulting and assisting people, isn't it about helping them also accommodate a lifestyle?
Yes, yeah, definitely. Definitely. That's why I think it's really important to try to learn and understand what is important to your clients. So the more time I spend with them in face-to-face meetings or over the phone or just hearing what's important to them, it just helps me get a better understanding of who they are and what's important to them and how can I partner with them to help them achieve those.
Now, I'm going to throw you a curveball, okay?
All right.
I want to know at the end of the day,
yeah,
at the end of life, how are you going to define success in your life?
It's not how much money you have. It's, are you happy with yourself? Are you doing what's important to you? Do people look up to you? Do people respect you? Do you make other people better? Are you an honest, ethical person? It's to me, it's really hard to define success, but there are certain words that I associate with success.
You can define attributes before you can. If a person possesses those attributes, then that's what success means.
Yeah.
Okay.
Yeah.
Joe, appreciate having you on the show today.
Thank you. Appreciate being here.